Welcome to Go Bank Yourself, where we break down how to grow and control capital like a banker. I'm your host, Dovi Herman, joined by my co-host, Pinny Levy. Let's begin.
Folks, this is episode 1 of the Go Bank Yourself podcast.
People will hear who we are and how we got here, how this came to be. But I was thinking we just jump straight into content because people are choosing to spend their limited time with us and we appreciate it. So tell me, what is the infinite banking concept? What does it mean for someone to become their own banker? Is that even possible?
Tremendous question. It's pointed out in other places, not just become your own banker as if you can arrive somewhere and now I'm a banker. And we're talking for everyone out there, theoretically, when no one's saying quit your job and go buy a bank or do what you have to do to amass the capital and get the licenses in the brick and mortar real estate, anything like that. We're saying becoming like a banker through a process of building your capital in a place where it's accessible. And when you do that, whether you're starting small, saying, I need to buy I need a quarter for bubble gum. All right, well, I can borrow from my bank and I'll use my bank and not someone else's. And along the way, we have to talk about, well, duh, as the kids used to say, no doy in their perfect northeastern Boston Ashkenaz. No doy. Why would I want to borrow 25 cents when I can just take a quarter and buy the gumball? We will cover why anytime you spend cash, you are losing interest. You're giving up interest. You're giving up the ability to earn interest in your quarter. So why spend it when you can borrow against it?
So you're saying that we finance everything in life, either by borrowing from somebody and paying interest to them, or we pay cash. Or we pay cash and we give up the ability to earn interest on that money forever. Because once it's gone, it's gone.
Exactly. And that's so where do you draw the line? That takes a little bit more...
Right. I don't know if buying a gumball for a quarter and leveraging your own banking system is going to be the
example, because what about a new washer dryer? Do you
absolutely
want to spend cash for a $2,500 washer dryer, or do you want to borrow it and pay on a finance plan? Most people wouldn't think twice to put it on a credit card and pay on a finance plan. Mm-hmm. What about $25,000 storm windows? Most people would definitely take whatever financing the contractor, or these days they'll probably put you on a 0% interest credit card until you break the terms, and whatever's left after 2 years will probably jump up to current interest rates.
Sure, but even these examples, I do agree. But when you have a 0% credit card, there is a good argument to be made to just go along with those payments. That's fine. Sure. But when it comes to
as long as the length of term makes sense for you for the payments.
Sure, and even using a credit card and you have the cash and you can just pay it off. But when it comes to a business owner who, let's say he needs a new $300,000 piece of equipment and he's going to use his revolving line of credit that he has with a local regional bank, and he doesn't think twice about paying that 9% APR.
And these are decisions that we just, you know why we do it? Because that's what we were taught. We were taught to use the bank's money. And sometimes the terms will be more favorable. Sometimes the terms will be less favorable. But where do you go when you need considerable capital? Someone else's bank. Your Bank of America, your Chase. I'll fine tune this for Crown Heights. Your Apple Bank. I don't know what your local regional is in LA. But we go to the bank for money. And certainly if we're stepping up and adding zeros for your $250,000 condo or half a bedroom house in LA, then you're going to go to the bank and use their money.
Yeah. And when we think about APR, that's just a rate of interest. But how much interest are you actually paying?
Yep.
Folks, do the math. On 9% on $300K, you think you're really paying 9% interest? The rate by volume is what matters here.
Imagine this. Again, those in LA, my heart goes out to you. But there was a time when interest rates were low enough, and I thought I had a sweetheart deal at 3.875. My literal house today, South Florida, 3.875. I think I borrowed 365K on this house. And if I stuck with the 30-year terms, and I pay that interest. The rate of interest, teeny tiny. 3.875 is a great deal, especially compared to today's rates, and the 6 to 7 is more. But the volume of interest was somewhere over $200,000, meaning I would be paying back something like 570 grand after the 30-year term is up. How much of that was
Sure.
principal? The 365. How much of that was interest? A whole lot. So the
Right.
APR doesn't necessarily, well, it's related to how much you pay in interest, the volume of interest, but you have to really know those numbers. Sometimes the decision point is, man, we really need to get into this house. We'll fix the financing later if the rates go down. But
Hmm.
a person ought to know what he's getting into.
And I
And I
think
don't think,
people understand that when it comes to mortgages, that you're paying so much in interest over that long period of time. And no one's saying that's a bad financial decision. A mortgage is a great thing to have for home ownership purposes and for tax purposes. And people understand that they're paying that much in interest with the interest by volume. I don't think people realize that that same principle applies to every loan you make, every
hmm
loan you take out on a car, on a personal loan, on equipment financing for business owners, for everything. That's just math. The
or
difference
in the,
between APR and interest
mhm,
by volume.
yep, or
And when we
in the
borrow, we're
Orthodox
always
world,
getting
cash.
screwed on volume.
Sticking to generalities on banking. Banking is when you need money, you borrow money. And we're just trained in the conventional wisdom to borrow it from a bank. So, how do we become the bank or the process of becoming the bank? Well, that just means putting money away and realizing that you can wear two hats, right? You start saving the money in a favorable place to be determined. And when you need the loan, you borrow from your capital and you go
Hmm.
to that, hat in hand, and you're wearing the hat of the borrower. But then after you borrow your own capital, make your purchase, buy the goods, the services, you have to switch hats. You see the joke? You're both guys, so you're not going to notice externally. And now I have to be the loan officer and I got to be tough with myself. And as long as I create a repayment plan that's profitable, well, I can make money like a bank. There's a lot to unpack there, but the idea of becoming your own banker is to make profitable loans to yourself.
And major players in a bank. You have a depositor,
hmm hmm
you have a lender,
The loan
and you have an
office,
owner
yeah,
and
and
an
the owner of the
owner.
bank who collects dividends no
So
matter what. Yep.
so here when you're becoming your own banker, we're gonna deposit our money in a very specific place. We're gonna lend essentially
hmm
to ourselves. That's the function. That's not the literal reality of the deal, but that's the function that we're playing. And we're the owner of this system. We are going to earn profits of this general entity that we're buying into and that we're starting. And we're
Yep.
beating around the bush a little bit, but for those of you who don't know, even though you probably already do, what's the platform? And we could get further into this. What's the platform that we use to
We
control the
use
banking function in our lives?
right. You want to buy a pair of Puma sneakers, take that box, fill it with money, and put it in your closet. That's the growth fund that we use. Yes. Make sure it's a strong shoebox. It will be important to put the money in a place where it can earn interest for you while it's sitting there idly. It'd be even
Ideally,
better if you can put the
ideally,
money guaranteed interest. That sounds good. Ideally, the interest you earn could be free from taxation. What do we mean there? I mean, if you had a theoretical 5% checking account or a high interest savings account paying you 4 or 5% per year, and your $100 grew magically through interest to 105 at the end of the year, well, here comes Uncle Sam to take, depending on your tax rate, 20 to 30% of that money. So if they take
sure.
30% of your $5, now you have $3.50 in interest that
But
you earn because you're net of taxes. Or opposite, you could have so much money in a checking savings account, the rate could be so low that you don't even meet the threshold of taxation because you earn so little.
when it comes to a checking account or
For
even
those, well,
major
I mean, for
bank
those,
savings accounts.
right, for those who flash back to 2012 or any time after 2008 when rates were well below 1% in any of these
Hmm.
accounts, and you just earn effectively nothing in the bank. So certainly a checking account, maybe a high yield savings account is the place to keep your money for your bank. if not for the taxation. Certainly has the ease of access. That's pretty cool, but you can
Doesn't
write
have the
checks with.
leverage ability because we're talking about borrowing. Once you spend from a savings account, that money's gone.
So that's already a real shift in thinking we didn't speak at all. Imagine if you could, while you lend the money, theoretically still earn interest as if you haven't lent it to yourself, or from the point of view of the borrower. I want to borrow that 25 grand for storm windows in Florida, a car anywhere in the world. What can you buy for 25 grand? A 5-year-old Honda Odyssey EXL, and you borrow the money. What if it can earn interest as if you hadn't borrowed it? If such a thing existed, I'd be interested. Anyone else? So we talked about earning a guaranteed rate of interest, no taxation. You brought up leveraging
Ownership.
it and earning money even while you are accessing the money through a loan.
Compensation for ownership, i.e. dividends.
Dividends, right? Earning dividends.
So you have
on the
guaranteed
money.
interest on one side, and on the other side, you have earning profits from the general entity or company being placed directly back into my system because I am a part owner of this.
Or more broadly, earning compound interest from this thing. Can you make the
Sure.
place where all of your profits are rolled right back into your banking business, right?
I like how you said compound interest because let me ask you, Penny, where in existence does somebody earn uninterrupted compound interest? Where does it even exist? Because people always talk about compound interest. How do you get it?
back to the bank discussions. A savings account APY, it might be 5% now, but read the fine print. If the market crashes, they have the right to change that. You might be back right down to 1%. So you would want a place without the possibility for such great fluctuations, and you would want a place where the money isn't considered withdrawn simply by accessing it. So
No risk of
such thing as
loss. So the money has to be safe to earn true compound interest. Is that true?
Right. You could say that unlike a bank doesn't have a risk of loss per se, other than a run in a bank, which is highly unlikely. But
Well, what about the stock market, which we're not endorsing or going against the idea of people putting money into the stock market. That's fine. People are going to make the investments that they want to make, but conventional wisdom says put money in the market. You're going to earn compound interest over a long period of time, but are you really? Because there's in certain years, and losses destroy compounding. You might have growth over long periods of time. No one's going to argue that. Growth is great. But is growth compound interest?
Right. It is
People
not.
will lead you to believe that it
average
is.
growth. Right. When they say if the
can
market
you
averages
go further on that?
5%, you want to?
Please.
Well, yeah. Is it truly compound interest if what someone will tell you is here's a 5% average, or really more to take a grain of salt with, the Dow is going to average 9% over your lifetime. So it's as if you're earning 9% compound interest for every stock you buy, every time you add to your portfolio. You can bank on 9% over your lifetime. It's simply not true because of the ups and downs. Meaning, go ask someone during the savings and loan bust, go in the 80s. Go ask someone during the dot-com bust. Go ask someone during the 9/11 bust. Go ask someone during 2008. There's a considerable loss of wealth and time spent getting back to zero or getting back to your starting point. So when that happens, anything called compound interest earning is out the window. Now you're spending time and effort to get back to where you were before the crash or before the correction, to say it more softly. So
and if somebody is totally fine with putting their money in that system and playing that game, that's great. But wouldn't it be even better to have an additional pool of capital somewhere else where it's safe and easily accessible to then access in times of these market downturns and, buy those assets at its lowest price possible without interrupting your own compound growth, your own uninterrupted compound interest?
Yep. We still haven't come out and said, well, where is this unicorn of a fund that we would want to put the money? But the
People who
actual
know
answer to that
us
question,
already know that people who don't, maybe you've just stumbled across this in the YouTube algorithm because your algorithm loves you as much as it loves me. Gives me great content. We're talking about dividend paying whole life insurance policies. Ideally structured a very specific way, but there are many different ways to structure it. We don't have to go into that right now. It's not so important. But we use dividend paying whole life insurance policies with mutually owned life insurance companies that have been paying dividends each and every year for over 100 years. And those dividends are baked into how the insurance companies conduct their business. They're as close to guaranteed as you can get in the financial world.
the risk in exchange for the known growth rate on these. Meaning, if what gets you excited is the possibility of the market spiking to 50,000, I just checked, it's down below 47 now. I don't even remember. I don't follow generally, so when did that happen? I don't know. But as high as you felt when you're in the market, not necessarily your stocks or your mutual funds, but when the market overall was at 50, yes. How do you feel now that it's at 46 and change? Less yes. Less yes. But without that fluctuating risk reward, we're talking virtually no risk and a known reward. It just takes time. And when the return on investment is through the roof.
I want to focus so much on this whole life versus the stock market that it seems like in the last 10 minutes we've almost been comparing a lot, and that's not the comparison. The policy, the function of becoming your own banker is really an and asset. Like I was saying before, if you can save money in your own banking system first and leverage it to go buy your investments. And if your investment is the stock market, then that's great if you know what you're doing in that situation. But for most people, and this is where we can kind of go on another topic if you want to, but most people are taught to just put their money in a 401k, market-based investments. Don't worry about it. Don't think about it. Just give it to Wall Street and Washington and defer taxes, and it's great because you'll be able to this year use your contributions as tax deductions, but then you're going to have to pay taxes on that at some point. And when it comes to distribution, using this 401k as retirement income, that's a whole other ballgame. Accumulation and distribution are two completely different things, and nobody focuses on that.
If you've ever sat in a HR meeting for a new company and they said, young man, young lady, you're going to be a millionaire by the time you're 70, if that's the retirement age then. By the time you're 75, you'll be a millionaire. And they didn't mention at all the taxes that you're liable for. And exactly where could taxes be? Where could income tax be if we're nestled right up to $39 trillion in debt? Where will it end, and what will it, to avoid that or any type of national economic tragedy, how high could taxes go? Let's say they only go to 30%. Well, your $1 million, congratulations, is $606,000. That's how much of it you get to enjoy when you factor in Uncle Sam's share.
And from one way of thinking, that is true. If you were to sell it all in that year, nobody's really going to do that. They're going to come up with some kind of plan. But still, if you're going to take $60K a year from it, how much money is that really? $45,000 in spendable income?
Mm-hmm. Think about it. How much do you have to distribute to enjoy the amount of money you really want? If you want to really do the math, take your tax rate, take the inverse and divide by the inverse. I want 50 grand. My tax rate's 22%. Divide by 0.78, and you'll figure out how much you need to withdraw to enjoy 50 grand. Mm-hmm. I have no idea. Who knows the math on that?
And the later in life that you are, the less risk you can tolerate. Who can afford losses from their retirement income? When you draw down income, when you sell at a loss, it is that much harder to then make up that loss. And the risk of running out of money is greatly higher.
Sure.
So again, doesn't it make sense to have a built up reserves in a system where you have guaranteed growth, where you have no risk of loss? That gets better and better every year, as we'll talk about in future episodes, that by the time you're in your 70s and 80s, and hopefully we're all alive and well and we're looking into our 90s and 100s, how efficient that policy works, or your system of policies, how much money you're really earning 40, 50, 60 years into
and
this.
we haven't even talked about, we'll maybe land it here, that there's, with all of these systems, these banks that you acquire and build, there's a death benefit. And at the end of the line,
Sure.
for anyone, there's guaranteed tax-free money, bigger than any premium you ever paid in, any capitalization you did to this bank flowing back into your family, for those that really care about leaving something behind, which hopefully is all of us. I think we're in a community where we think about the next generation as much as we think about all the simchas we have to pay for along the way, and schooling and yeshiva and tuition.
Yes, and we can definitely get into the best ways to self-finance these types of major purchases, the large weddings that go on in our community every month. It seems like. Baruch Hashem, I live here in LA, in Valley Village. Over the last few years, over the last couple decades, we've been thriving economically. It seems like this community is doing really well, and there are giant weddings, giant Sheva brachos. People are spending hundreds of thousands of dollars on these parties, and it's beautiful. But what are they doing? They're spending down their cash, or they're taking out huge loans that I'm sure they can afford, and I'm sure they're going to be able to pay back, but they're doing one or the other, and there's just a better way to do that.
Yeah. Apart, square brackets, the whole discussion of, I think in Lakewood now you have the option of highly subsidized weddings they're toning down some of the extravagance or in these simchas. But either way, with our way of thinking, it would be, well, I got a break. This wedding only cost me $30,000. The other 50 I was gonna spend, how about I put that into my bank instead? Different ways to look at that. What's gonna come to play, no matter what discussion of building a banking system, is your fiscal discipline. What do you do with your money when it comes into your reshus, into your domain, before you deploy it on expenses or investments or we will get into all the aspects of building your own banking system, the perfect place, what that looks like, how it's designed, in future episodes in Mitzvah Shem. And thanks for joining us.
Yes, thank you, everybody. The title is a work in progress. Right now, we're thinking go bank yourself, because we should all go bank ourselves and become your own banker. Thank you for listening to Go Bank Yourself. To learn how to apply these strategies in your own life, email Dovi Herman at realchangefinancial.com. We'll see you in the next episode.